All right, let's rock and roll. Welcome everybody to another episode of the podcast. I feel like there's been a lot going on the last couple of days. We're sitting in the middle of the week where everyone is kind of scratching their heads. Is it the end of the world, or was this a fat finger trade? What's the word?
I'll tell you what though. Like I think because this whole podcast was born into the Nvidia top, like I think we're on a roll. But I do think we gave a bad impression, kind of being absent for about 3 weeks or so. It wasn't
Agreed.
because, like most gurus, we were scared to talk about the market. It's just that we were doing summer things. So we'll make up for all that today, I think, with a little bit of discussion on what's going on and kind of what to expect, right?
Absolutely, absolutely. Yeah, summer. It's interesting because summer, obviously, you got a bunch of kids, I got a bunch of kids, and summer gets a little crazy. But it's also kind of the time where trading's a little thin, right? Volume's a little thin, and so if these things are going to happen, summer is probably going to be a little more of an exaggerated version of it. I mean, literally, it was like Friday, Monday, two days, and everything fell off a cliff, right? I mean, that's probably in like more normalized market conditions, it may not have been so extreme. Or do you think this was a long time coming? What's your take on it?
Well, there's that old saying about like, sometimes it takes years for things to happen, and sometimes years like happen in a couple of days. I really do think that the some of the things that happened in the last 30 days are of incredible significance. We first, for starters, I think we talked about how we were in a really unhealthy market environment. When the market gets really, really narrow, and you notice that like the chart of the S&P or the QQQ just don't look like the majority of stocks that you're looking at. When you look at the Home Depots of the world and the Bank of Americas and the Nikes, and you look at the FedExes and the UPSs, and you look at the Walmarts and Targets and stuff like that, and none of those charts look like the S&P. Well, something's amiss. And like the last, gosh, I mean, it's really, to me, it's been the last 6-7 years where like the market has gotten really into this whole thing of like concentration, and like passive investing has become its own little bubble. And those are discussions for later on down the road. But like the fact that things are so narrow is, it's just not a healthy condition to have, and it doesn't represent what the real market is going through right now. I think the best thing that we talked about in our last episode though was like we said that, or we were talking about how I think that the tech bubble has to come undone a little bit for the rest of the market to flourish. And I don't know, I mean, it was about a week or maybe within a week to 10 days after we had that last discussion, the Russell 2000 had a record move, right? The small caps exploded. There was so breadth thrust is a condition where a lot of stocks signal a powerful upside move all at the same time. And the Russell 2000 had its first official like triple breadth thrust in history. And that happened as Nvidia started to tumble, as Microsoft started to tumble, as Google came in a little bit. The rest of the market got healthier. But which we should have followed up with a podcast and said, hey, this is great. This is great. But part of the other extremities is you've got a little bit of confusion right now that with the labor reports and the Federal Reserve, and I think the market got a little nervous that the Fed's behind the eight ball. In fact, yesterday they were talking about there was like a 60% chance of an emergency rate cut, like in a quarter point. Like, what is this? Is this 2008? Like, we're gonna drop rates a quarter basis point? Like, come on, dude. Like, that's just wild to me. I think what happened with, and you and I have talked about this, with the extremities going on in the currency market, right? With the yen that's been going wacko and the carry trade unwinding. I don't think that. So here's where I'm at. I'm not really super doom and gloom right now. I do think that this purge we had was needed. It doesn't need to be super deep and catastrophic, but we did need to wiggle money out of 10 stocks so that it can go to the other 5,000. You know what I mean? So that we can realize there's better deals on here than chasing, growth estimates and growth rates and tech stocks. So I think there's a little bit of partial nervousness about, recession fears, which went from 10% odds of a recession to 25, but that's still pretty low chance of going into recession. Wouldn't you agree?
Yeah, I feel like those numbers are decent. I mean, was it 2023 that everyone was like having their 80% chance of recession predictions, and
Yeah.
they were
Yeah.
just all over recession, and then we kind of got out of it, and it's creeping back to like a normalized number, which takes me to kind of the next, or kind of a follow-up. You and I have discussed plenty where we've said, okay, when money starts to come out of the 5, 10 stocks, right? The mag, whatever they turn out to be, the mag 6,
Yeah.
do we still have 7 of them? So when money starts rotating out of that really concentrated sector, will that crash the market, or will that do what we saw? And has the rotation gotten underway enough that the shock factor is over? Because I was definitely a bit on the fence of like, is it going to panic the market when all this late money is in Nvidia and all the Mag 7s? Is that going to panic the market a lot when money starts, simple profit taking, right? Simple moving to better opportunities. And I would feel like the reaction that we had, if that was at least partially due to rotation out of those, like it was an appropriate reaction. And I feel like that was enough panic to get people back on their toes. Like, I think that was it seemed overreactive, but at the same time, when that concentration breaks up, that seems like a fairly normal kind of response to something like that happening.
And there's only been two times in history where like where the S&P makes consecutive monthly declines while the Russell 2000 makes consecutive monthly advances. The only other time I recall that happening was in 2014, and it was a similar situation. Back then, the the Mag 7 back then were mostly like cybersecurity stocks, software. I remember like Salesforce.com. I remember Workday. I remember Splunk. I remember Palo Alto Networks. And those stocks, they took a 60% haircut in Q1 and Q2 of the year, while stocks like Apple and the S&P kept trending. And it created this really weird thing, which is it's not normal to see. Again, you show the Nasdaq start to tip and the Russell explodes higher. It just shows that like there's a let me put it this way. There's a difference when everybody's chips are on the table and everybody's got to pull all the money out and the market crashes. It's completely different when, and if you look at a lot of volatility indicators and stuff like that, like for the most part, correlations have been really, really low. And like, it's not the kind of, and financial conditions like credit, like high yield spreads and stuff like that are really, really low. There's no system risk here. There's just human error risk. And so usually that happens when people get smart and they leave early, they put money in other places. There's difference where markets are ready to crash, and there's difference when money just rotates. And I really do feel that when this had a little bit of a slower pace, you could see by the Russell taking off that money wanted to rotate. I think with the Fed news and the yen, I think the yen set off a lot of macro funds. Like
Yeah.
sometimes when the 10-year hits a certain mark, people will sell a certain amount of stocks and buy a certain amount of bonds, or vice versa. I think a little bit of that happened at the same time. People got worried about the Fed, but I think the best data point about the post Fed move is that it wasn't recessionary stocks or recession sensitive stocks that really got hit the most. It was tech stocks. It was
Yeah.
really, really ugly tech stocks and unhealthy like ARC type components got slaughtered. It wasn't like you woke up and saw Alcoa down 20% or Boeing down 20%. You know what I mean? It wasn't.
Yeah.
Caterpillar was pretty strong that day if you go back and look. Just like things like that. Like usually you can kind of put those components together and it tells you a story, and that's kind of the story I thought.
No, for sure, for sure. It definitely. I mean, there was plenty of leading indicators there. I mean, obviously everyone's looking at the 10-year yields quite a bit, and those 10 years have been going down for 30 days, right? That's down a percentage point in the last 30 days. So that's been kind of leading this pack a little bit, and I think that probably got people's attention a little bit as well. And it kind of felt a little bit like like what's a good example? I mean, it felt like money was on the edge. Like we should be out of this, but
Yeah.
for the
Well,
last year and a half, getting out of this was too soon. So let's just wait until there's any kind of wrinkle, and then everyone kind of just panicked. But
they always say when there's smoke, the door always gets smaller when everybody wants to leave, right? So,
for
but the
sure,
thing is like a lot of this makes sense in the sense you bring up bonds. I mean, the 210 has uninverted, right?
yeah.
And so I don't know what happens if we go into an environment where we're steepening. Like that changes everything. And I think at the end of the day, all of the things that we're dealing with here and these extremities have everything to do with the financial experiment that we did back in 2009 when we decided to keep rates down to nothing for a decade. All of these things are bad habits and products of like something that was really, it's not an experiment, because Japan did it forever ago, but it's like, it's the market's going to kind of kick and scream a little bit, getting back to having yield in the market. And therefore, if that's the case, if yield is here to stay, what are you willing to pay for growth? And I think the prices people are willing to pay for growth are still pretty high.
They're still up there. They're definitely up there. Do you think there's an element of, obviously this discussion's been out there, but is the public coming to terms about the fact that AI really may take a while to convert to profit? That the hype of AI might be a little further out than everyone thinks.
It's like whether it's bitcoins or it's the internet or it's cannabis, it's like, oh wow, this could be huge, and then the reality sets in 10 years. You know what I mean? So
Totally.
it's with every ramp and fade, it's like we really see the tunnel, the 20-year tunnel, as like this is going to change the world, but it doesn't change all the work that has to get done between there and now. And so with any growth theme, I would say, if we didn't have people involved, then prices would appreciate at a 45-degree angle, right? But because we get really really hyped and then we get really really trashed and we go all back and forth, it just creates all this volatility and havoc, and it's the human element that screws all of this up, to be honest. So I just think you're at a point where it's like people got to where they were willing to pay any price for growth, and that's always scary to me. And like I just think long term, if we're going to reintroduce yield to this environment, I think the real economy is still so incredibly mispriced. And that's why you saw the NYSE break out and the Russell 2000 break out, all when Nvidia and those stocks started to roll over. That's just what I think the underlying message the market's going to keep sending is.
So when you say economy is mispriced, what are the do you still are you still kind of standing by some of the basic sectors that you think have been ignored? Like what part of the economy do you think is underpriced? I mean, obviously tech and growth has been overpriced. It's always kind of overpriced. What's the most underpriced portion of
I
it?
mean, tech is always great. You gotta have tech in your portfolio, but you can't chase hype. You can't chase hype because when everybody decides and the reckoning comes, it's just going to challenge your will to be involved. And if you're not in from good prices, you end up being underwater, and it ends up you wasted all this time. Like I just think that like I mean I've been talking with you about this. I mean I really really got on this whole value rotationary theme from back in like 1999 and 2020 or excuse me 2019 2020. Like I started buying up energy material resource stocks because if we are going to reintroduce interest rates, and that stuff is incredibly mispriced, and they had a hell of a run from 2020 to 2021. They've consolidated for 2 years, and all the while, while commodity prices still, they're not back down to where they were pre-COVID. We've established an elevated base, and so I think most of these energy stocks and resource stocks have kind of digested that move. They got a little nervous here recently when the recession word was kind of rolling around, but I think in the over the course of the next 5 to 10 years, the real economy, which is resources and construction and infrastructure, energy, I still think those things are incredibly mispriced. I mean, you keep hearing like Exxon is making record revenues at $75 oil. You know, we're not hanging out between 50, $60 oil anymore. We're hanging out between 75 and $80 oil right now. And I know there's some war premium in there and some Middle East premium, but there's also some like, hey, we're not really all that much in a recession premium right now either.
Interesting. Interesting. It's so I'm gonna say something that I may have said the opposite of in the past, but but so I've been a Tesla fan. I'm a Tesla fan.
Yeah.
It's been interesting. I like the stock. I think there's some interesting elements there. I think Tesla has some, plenty of potential. I think they're doing smart things over there. But at the same time, so I have, Hendrix, my kid, he's obsessed with Teslas. So we rented a Cybertruck for a couple days.
Ooh, I'm thinking about getting one of those. I hated the electric vehicles, but that Cybertruck, I really, really want one.
The Cybertruck's sweet, man. It's sweet, and he's obsessed with it. And it's funny, we drove around for a couple days in it, and people would like give us the bird, or they'd be like, so awesome. Like everyone's got such an opinion on it. It's the funniest, like polarizing vehicle I've ever been in. But I've never owned a Tesla or any kind of electric car. And as cool as the Cybertruck was, the what's the word? The growing pains, the transition pains of an electric vehicle versus gas, I think it's healthy. It's healthy. I didn't get a Tesla and give it back and think I gotta buy one of these. I was like, I mean, there was a point where we were in a random parking lot at an apartment complex, because that's where the Tesla app told me to go to find a supercharger, because I'm figuring out that there's like these fast chargers and these slow chargers. There's one by my house. I plug it in. They're like, your car will be charged in 9 hours. I was like, I got to find another one. So then, so then I find this Tesla supercharger, and I'm sitting in like 100-degree weather, just plugged in for like 30 minutes or 40 minutes charging. It costs like the same amount as like a tank of gas basically to charge it up. And I thought,
does it? I didn't know that.
Yeah, it was, we had 50% battery, and it costs like $35 to charge it to 90%. And I was like, I thought this was supposed to be like $10, so then there's like this stuff there, and I looked at that. So anyways, the reason I bring all that up is I'm like, I can't be the first person. I say a lot of things that I have no actual backing to like support my opinion. But this one, like I experienced it, I went through it, and I thought to myself, I need to buy oil. I need to buy energy, because like we're not in an electric car world yet. There's a million Teslas. I see them everywhere, because when I'm with Hendrix in the car, he goes, there's 1, there's 2, there's 7, there's 10, and he just is always talking about them. But I'm like, we have a solid generation at least before these really take off. Like, it's just, I'm 44, man. I'm not like a major old timer that can't transition to a new way of thinking. And it was tough. It was tough. And so it made me think, I started looking at these energy stocks, and of course we have, we have political situations coming up at the end of the year that could change how energy is managed and so on. But it just made me think, these guys are killing it. Nobody's talking. I mean, is anybody talking about oil? Like, is anybody, I feel like I don't see or hear anything about it anywhere.
The only time they did, I told you, like I spent 2019 and 20 buying up like just dozens and dozens of oil companies. But it wasn't until Q1 of 2021 that the momentum ETF, MTUM, which is usually full of stuff like Nvidia and Tesla and all that, it started becoming full of energy and material stocks. And that was like the first warning sign, like this is probably going to cool off a little bit. But I think you're right, man. Like with newer technologies and you bring new things to market, it's like you go through the period of like being able to insert it properly. Then you go through the period of being able to maintain relevance. Then you go through the period of like, now we got to figure out like how to keep people engaged. And like, it was a cool story watching everybody bet against Elon Musk and watching them actually. I remember 5 years ago when I might see 1 or 2 on the road. Now I see 1 or 2 next to me, lane to lane, at all times. Yeah. So the growth there has been insane. but yeah, it's like those things where you get involved and what price you pay and all that really makes all the difference in the world on themes like that for sure.
Yeah, I feel like, I'm always torn between, Peter Lynch talks about go look around and see the products you like and you don't like and try to get a feel for what people are using. And I've always been like suspicious of that because I'm like, okay, are my sample sizes big enough to say, okay, I see everybody with an iPhone, I'm going to buy Apple, right? I see everybody with Ford, so I'm going to buy Ford, right? But it is interesting when you kind of get a little bit more of a feel for the up and coming versus the not up and coming, right? Like with AI is super useful. It's super awesome. How long is it going to take the population to get trained on it and implement it in a meaningful way, right? Like it's going to be a minute, it's going to be a minute. Electric cars, like the growth has happened. People accept them. I think we've gotten past, remember like a year ago or 2 years ago or whatever, when like every diesel truck was like parking in front of superchargers and like blocking them, I think everyone's just like, cool. It's cool. It's fine. Everything's fine.
Yeah,
So,
yeah. Now
so
it's like they're not claiming territories anymore as much, and they're just learning to live with one another.
yeah, we're just all getting along. So like, what does that mean for these sectors? Does that mean, does that mean that it's just business as usual? Is the hyper growth still there? Is it sustainable? I mean, and does good old energy? I mean, we've seen Toyota and Lexus were like big proponents of like, hey, we're going all electric. We're going to have, by 2026, nothing will be gas anymore. And they're kind of like, that was a little, that was
Yeah,
aggressive. So, I bring all that up because I just think energy is this interesting space. It really hasn't done anything awesome, like you said, for a couple of years. It's like removed enough from people's minds that it seems like it could be an opportunity again. But we'll see. We'll see. November is going to be a
yeah.
big
I
deal on
think
that one.
with the election coming up, and then with the curve steepening in a hurry, like the long duration assets and growth has a tendency to like kind of level off and slow down, while real economic type instruments and like commodity type plays always generally do pretty well. So like I just some of those things are starting to come together. And when people chill out about the whole recession thing, and when the Fed comes in next meeting and drops a quarter point and says, hey, this is everything's going to be okay, and then we're like, rah rah, economy's okay, I think those things are going to flourish pretty quickly.
So two important points that are like standing out in my mind in the economy. Number one, if everything is fine, we've got some yield back in the market, the we don't get hit with a recession super hard. Are we in a do we think we're in a space where the next hype will be a new technology introduced, or are we still riding enough on AI that there's no development for new technology? And or are we kind of, I mean, you have some teenage kids, right? Does Jordan, does he seem to be, we hired this 18-year-old kid to paint something for us, and he had like CDs, right? Because that's their like retro thing. He was like listening to these CDs. So is the market going to go back just a little bit and just be like, hey, let's buy some manufacturing stocks? Like we're not we've been through enough hype right now. Let's just hit some good old like tried and true energy manufacturing. Or is there something sneaking in the wings that nobody's talking about that's going to blow the doors off the hype train again?
Well, I'll say this. I'll say right now that if you told me that we were at a threat of like last year, for example, when recession odds were much higher, we were flashing under $70 in oil prices, and we were like at $3.40 copper prices. Fast forward to today, we're $75 oil and we're $4 copper. Those are not recessionary prices. Okay, even though they've come in, they're not recessionary like levels. And you talk if you listen to the Ivanhoe CEO, their big massive copper miner, huge discovery they had a couple of years ago. He's saying the same thing. He's saying that the real economy is going to make a real comeback. And like the thing is like if copper's at $4, Freeport McMoran shouldn't be under 40. If oil's at 75, Occidental should not be at 30, right? Those like Occidental was at 40 last year when oil was lower. There's a massive divergence going on here where people are kind of piling out of some of these names, assuming that things are going to get bad, but we have no evidence. And trust me, commodity prices, especially copper is the most responsive to economic stress. And we have $4 copper prices. We rarely see copper above 4. You know, I mean, we got during the inflation run up, we got to 5. We got pretty close to 5. $4 copper, $75 oil is like something's off here. And usually equity money is the scared money, right? Not the commodity money. Equity money gets, is more human error than anything. So, but I'm super biased towards that stuff because of the bigger picture here with interest rates doing what they're doing and all that just to me screams that that's the best play in the long haul. But let's be honest, like, you know, Apple is not expensive. Amazon is not expensive. Meta is not expensive. I don't want to talk that stuff down like you should avoid it. But like, I don't think like I wouldn't be overexposed here, like I just, because at the end of the day, when people panic, right, you get 100 investors in a room and they all panic at the same time, they can only sell what's in their portfolio. And stocks like Nvidia and Meta, and they have hit critical mass, right?
Yeah.
10 out of 10 people right now own Nvidia. Their CEO was signing cleavage at an investor conference a while back. So like they've hit critical mass, right?
It is interesting to see. You're right. I mean, can anybody else buy this stuff, right? Now, at the same time, that makes me wonder, like, with how much interest there is, like, do you think there will be a meaningful bounce? Like, how much is, let me just look at this Nvidia chart. So Nvidia
look at how
is
much
off.
they trough, though. Look at how much they trough and how much, like, it's what happens is when you sell that hard, the late buyers start to punish the guys that bought pretty decent. The guys that are in the middle are watching that gain go away. And you don't trigger the guys that bought at 100 until that stock really takes on another. It's just a difficult environment right now, and so I would take your time and just, if you own from a great price, awesome. But if you have a lot from higher, I would thin out a little bit, to be honest. Like, it just doesn't do it for me. Like, you look at a stock that's been a 10 bagger in a year and a half, and like takes them off the table. Druckenmiller sold his whole position a couple quarters ago to go buy the Russell 2000. He bought Russell 2000 calls after he sold his Nvidia position. It just, I think most guys see the bigger picture here, and I think over time that's where the real opportunity is.
No, for sure, for sure. I haven't owned any Nvidia in quite a little while, but it's interesting to see. I mean, that high to low over like a 30-day period is like 35%, right? Like
a lot.
I mean, that's significant. A third of its massive market cap just vanished, and we have this big bounce, over the last kind of 2-3 days, but it's running right back towards that 35% drawdown, and so it's interesting. And the only reason I wonder about that is because if these stocks have had so much attention, have there been the people on the sidelines saying, okay, had a big sell off, let's buy it. But are they enough to make the bounce happen, or does this thing just steamroll all the people that waited way too long?
Those are the people that have really small hands, so like this is all self-fulfilling prophecy, man. Like, when you look at the big volume selling that's already taken place, those are the guys like Druckenmiller and all that are like, look, I'm going to let the little guys all screw this up, and I'm going to let the message board guys like take over and screw themselves and shoot themselves in the foot here. I had a good run and I'm out. And so like, I know this for a fact. I know you don't have guys like Druckenmiller and Mike Burry, and you don't have those guys waiting to get into Nvidia. If anything, some of those guys are probably more open to shorting the stock than really wanting to do anything with it. So, when it's a message board conversation, leave it to the message boards, man. Like, try to go where those guys aren't. Try to, try to get to the point where they will end up being 6 months from now. Like that's just the only way I think you can play it.
No, for sure, for sure. I think it's exciting to see, and I think you said it fantastically well at the beginning of the podcast. It's exciting to see the fact that we might start seeing other charts looking like the S&P because when people say, "Hey, the stock market's up," and you're like, "Well, 500 or so of those aren't." But
If you had a diversified portfolio, you're probably losing money this year.
yeah, for sure. For sure. It's, and this makes it tough for fund managers, right? Because they say, "Hey, the S&P's up this much. How come you're not?" And you say, "Well, then just go buy the S&P. You just put 100% of your money in that and enjoy the ride. It's going to be a wild one, but enjoy it." But it's good to see the market kind of clearing the pipes a little bit, starting to get a little bit of opportunity for these other stocks. There's a lot of cheap ones. I'm gonna throw one out there that's super left field, random as ever. But I feel like for whatever reason, somebody brought this up, and I kept looking at just revenue metrics, price to cash flow, everything, and it looks like it's super historically cheap. Are you ready for it?
Probably.
Lulu.
100%. So we haven't talked about actual buys or sells recently. I just bought Lulu yesterday.
Shut up! On the same page here. Okay. I've been watching Lulu for a couple weeks, and I thought, what is going on with these guys? Lulu is back to, this kind of messes it up because COVID really put some numbers into whack, but it's back to like May 2020 levels.
I was like, there's no way it gets down there. And I'm wearing a Lulu polo that I just picked up like 5 days ago, but like, I have no interest in anything like that. But with every stock, there's a price that you absolutely cannot resist. And that price that I didn't think would hit on Lulu. And I said, well, you can't not own that stock at this price. That's how I look at investing.
That's funny, man. I feel like we've had a couple of stocks recently that have been screaming, and Lulu's an interesting one. So
yeah,
it's, when my wife comes home and says, "Hey, I got some Lulu stuff for the girls," and I think, which girls are we talking about? Like, this is wild. Yeah. I love me some Lulu.
I went to one of their stores out in California and waited 25 minutes to check out, and like you couldn't get somebody to help you because the place was just infested. So I was like, yeah, the stock chart and what's going on out there just didn't really make sense to me. And when I saw it, I was like, in 2016, I bought Lulu because Jeff Mackey and we were doing an investing conference together, and we both got out there on the podium, and that was both our favorite ideas simultaneously. And we're like, hey, so yeah, I'm right back to it. I think it's just like probably one of the best buy in retail right now, no question.
I love it. Lulu's freaking great. Well, we got some good stuff to keep an eye on. I think that's an important discussion. We have much to cover next week, so everyone, make sure you tune in.
Why don't you and I get back to this a little more frequently?
I know. You know what? Honestly, I'm so ready for kids to get back in school. Like, I feel like it has been a madhouse. When my 9-year-old boy who has endless energy said, "Dad, when does school start, man? Like, I'm kind of over this summer stuff. Like, I need to get back in school." So we'll bust another one out next week, without a doubt. We have great stuff to cover, and certainly as things continue to develop and unroll, and we watch some of these recommendations play out. Not recommendations, things we're watching.
And when the gurus get quiet, we should get a little more noisy, because like everybody out there is kind of like, I don't know what's going on, so maybe I'll just sell you a book or a subscription service.
How about a nice monthly? Let's go.
Get my monthly.
Oh, great stuff, man. Thanks as always, Jeff. And thanks everybody for watching. We'll be back next week with more comments on these wild, crazy markets. Who knows what'll happen between now and then, but we'll have some stuff to say about it. So
for sure.
Thanks everybody. See y'all.
See y'all.